talking about in the coming weeks as we head towards the holiday shopping season. Back over to you, Brian.
Don't have to wait that long. We're going to be talking about Target like the next couple minutes.
There
Tom
you go.
Chu, thank you very much on our earnings exchange. All right now, though, happening, short seller Carson Block just laying out a huge new short. Let's go right now to Jumana Bersetchi, who is at the Sohn conference in London with Carson Block of Muddy Waters. Jumana.
That is correct, Brian. So we're here at the Sohn conference in London, and joining me right now is Carson Block, the founder of Muddy Waters. You just came off stage talking about your latest big short. So tell us what it is and a little bit about the rationale.
Sure. We're short dLocal, which is a payment processor. It went public in 2021, and it focuses on emerging markets, especially Latin America, very fast growing, margins that are far better than any of its comps. And the short of it is, we are highly concerned that this company is a fraud. So what we first saw when we looked at it were just revisions in what the company was saying about the components of its processing volume, and then also discrepancies in certain accounts receivable. And a lot of times when we see that's those sort of mixed or those contradictory disclosures, that can be because when you're not telling the truth, you kind of forget what you said before and things don't balance
Headache
out.
from a
so
cold.
that
This
told
isn't
us
how you
that
get relief.
there's a good chance there's something seriously problematic here. And then when we dove deeper into the company, we actually saw a series of events in accounting related to a loan that was actually made to pre-IPO to the president and the CEO, that the company seems to have taken pains to rewrite history. Now, our view is that either the disclosures around this are inaccurate, grossly inaccurate, as a result of a level of incompetence that few of us will ever experience in our lives, or it points to fraud. So likely they crossed the Rubicon there in terms of changing accounts when they shouldn't have changed them, accounts that diverge from reality. And then we get to these questions about how the funds move. So when you look at the company's accounts, remember they're handling billions of dollars of other people's money per year. I mean, the annual run rate now is almost $11 billion. So at any given time, there's a lot of money sitting there that doesn't belong to them. And when we reconciled, or we did reconciliations for 2020 at the consolidation level, meaning what they report in the SEC filings, as well as one of the key subsidiaries, it doesn't reconcile. It doesn't. The company did not have the cash flow to make the payments in 2020 that it did. So that certainly brings up concerns about controls over client funds. Now, I will point out that the other possible explanations there are that the disclosures that we relied upon are inaccurate or they're incomplete. But again, we saw this at the consolidation level and at a subsidiary level, and the subsidiary level is a lot simpler than the consolidation level. So
that is quite a big allegation of fraud. I should mention also that CNBC have reached out to the company. They have responded with no comment.
Okay, I'm sure they will comment eventually.
Well,
yes.
I want to just pursue that point because, again, it is a big allegation to call out a company for engaging in fraudulent activity. How do you discern the difference between, say, a company coming out with aggressive or optimistic marketing material and reports, which is within the realms of what's legal, versus actually engaging in ill faith, bad faith behavior?
Oh, that's a great question, because a lot of times what we saw, for example, with the SPAC booms, SPAC boom was really about these overly optimistic, forward-looking statements that people can fall back, companies could fall back and say, well, these were statements of opinion. We're talking about what did and did not happen and what the accounts show and what the company said about history. And what the company says about these loans is not what actually happened. In the report that we released, we have a lot of paperwork that we've taken from subsidiary filings that show money moving at times and in ways that completely contradict what the company's story is. And again, when you get to the cash flow, this is the sort of reconciliation that other investors can do. And we provide the information in our reports to do it as well at the subsidiary level. But those are, this is all based on their filings. Now, the one other thing that's also really important to keep in mind with this company is that when it went public in 2021, directors and managers, including some former directors and managers, sold about $330 million worth of stock in the IPO. The company only sold, I think, about $87 million worth of stock. Then there was a secondary offering just 5 months later in which the same group of insiders sold over $600 million worth of stock. So within 5 months of being public, and this is also within just about a year of Wirecard blowing up, which is in the same industry, within 5 months of being public, they sold about $1 billion worth of stock. I'm talking directors and managers, not just the venture capital fund that backs them.
Hey, Carson, hey, Jumana, thank you. Carson, it's Brian Sullivan. I want to make very clear, I think Jumana mentioned it, want to make very clear that these are your allegations. This is your proprietary research. And we have reached out to the company, so if and when they comment, we're going to bring it. It could be in a couple of minutes, could be tomorrow, could be never, to your point. But I want to make that clear. These are serious allegations that you are making, Carson. That said, in your report, you note something called regulatory arbitrageur. What does that mean? How does that fall into your thesis? And if I were the company sitting here interviewing you and I said you're wrong, where could your thesis be wrong?
Okay, so to the first question, there's a long list of governance failings that we've published. And one of them, and the key one, is regulatory arbitrage. Specifically, we see that the company appears to be intentionally dodging regulation by the UK's Financial Conduct Authority, the FCA. And that's important because in 2020, so that's just in the lead up to the IPO, that's when Wirecard blew up. And within weeks, the FCA significantly tightened the rules and supervision of payments companies. So there are two primary subsidiaries that dLocal has here in the UK that handle a substantial amount of the payment flow. Well, one of those subsidiaries was set up in 2020 and apparently has no employees. The other subsidiary, which was a legacy one, at the end of 2019 had 57 employees, I believe. The end of 2020 had 0. Now, why is that? We suspect that the company is trying to avoid supervision by the FCA by saying, hey, we have no physical presence here. But that's not true. They have a bunch of employees who apparently were novated to the Uruguayan entity but are still based in the UK. So we're not certain that that's the exemption that the company claims to avoid being regulated by the FCA, but we suspect it is. But regardless, these are major payment processing entities, and we see no reason why they're not licensed by the FCA and overseen by the FCA. Instead, they're overseen by Malta under an EU payment processing license. Now, as far as what the company would say, I don't know. We present a lot of different elements here. I mean, they probably wouldn't ask questions, but I think they would just, look, what companies tend to say is, you don't understand our industry, you don't get it, and your report is full of factual errors, and you're a short seller. So what I invite the company to do then is to go out and actually explain what those errors are. Now, a lot of times in those responses, though, they won't answer the questions that they're actually being asked. They'll answer questions that they wish they were asked. So investors need to read closely, unfortunately, side by side, what we wrote with what the company says our allegation is, and then try to figure out whether the company is actually responding to our conclusions or they're just effectively responding to something that we're not accusing them of.
Carson, can I ask you about sizing here and quote unquote staying power? Because oftentimes it takes a little bit of time for these shorts to work out. You're drawing some parallels with Wirecard over here in Europe, which was a big story, similar kind of story that you're presenting. But it took a while for the short to play out. So how are you thinking about sizing your position?
So it took years for that to play out. And I mean, really, Wirecard first came under suspicion in 2008. And for anybody who shorted Wirecard in 2008, I mean, the stock went up numerous times before it blew up in 2020. I mean, one thing that's a big difference here is that Wirecard was protected by the German state. They had the regulators go after Financial Times journalists as well as pretty much every short seller who spoke publicly about the company. That will not happen in the case of dLocal. So I don't think you get that kind of protectionism. But I mean, we have to manage positions. There's a threshold that when a company breaches that threshold, we trim. And then when the stock starts coming down, if we think it's broken, then we'll add back. But it's hard managing risk on the short side. Vast majority of short fund managers have gone out of business since the financial crisis. So it's more art than science when it comes to that risk management.
Carson, I want to jump back in and change gears. By the way, DLO stock is down about 26% on this. And again, we are waiting for the company to respond. If you're out there watching DLO management, give us a call, send an email. We're here for you. I want to talk about a bigger potential fraud because you're known to dig into books for months or maybe longer. And I want to talk about FTX. And sort of bizarrely, Carson, actually, they are connected a little bit because in a regulatory filing, dLocal says it had $5 million with FTX. That's neither here nor there. What do you have a take on what's going on at FTX? Because it appears that there's more due diligence being done on somebody applying for TSA pre-check than billion-dollar institutions did on this firm. And I want to get your take as somebody who digs into books for a living. What the hell happened here?
Well, I think this is a great example of greed and FOMO. I mean, I'm going to be a little bit glib for a moment and speak as though there is a collective mind that controls these things. But when it came to crypto, okay, why did everybody flood into crypto? Well, during our lifetimes, we saw the equity bubble, right? And people such as myself, even though I wasn't a short seller, but I was still skeptical at the time, said, hey, this doesn't make sense. It's different this time. Turned out not to be. So retail was easily able to buy equities. They learned a lesson. Then houses. People like me voiced skepticism. No, it's different this time. Then that blew up. So there needed to be, in order to have an enormous bubble, there needed to be an entirely new asset class that nobody could say, well, this has happened before. Because to get this kind of bubble and to trust charlatans like Sam Bankman-Fried and his coterie, you have to have a suspension of disbelief. And so it needed to be an asset that barely has any value. I mean, the crypto, as I understand it, there's generally some value in the gas fees. But if you look at the value at which these things trade, I mean, we're talking the real value is a sliver of the entire price of these things. So it's been a bubble and it's been unregulated. I mean, these guys sit in Bermuda. I mean, so who's minding the story? Bahamas, yeah. And this was one of these things that several months ago, I just quickly took a look and I just felt there's obviously something wrong here because he went from zero to I'm worth $20 billion. I'm putting our logo on Major League Baseball umpire uniforms and on the Miami Heat arena. It seemed like really trying hard to establish yourself as a household name. And there was an interesting article that was done, I think, last September about Alameda Research in which the reporter said, oh, we verified the assets of blah billion, but it was substantially all in Solana. And when I was reading this, Solana had tanked, and they didn't talk about the debt. So when Sam Bankman-Fried was out there saying, after they owned 20% of Robinhood, maybe I'll buy it, that said to me, this is a guy trying desperately to avoid a margin call. And then, I was wondering, okay, well, what happened to the value of all the assets relative to the debt that I assumed Alameda had? Yeah, it's client money. And again, when nobody's minding the store and there's very little regulation and it's an asset that really is of questionable reality, this is what you get.
Carson, a question on your broader portfolio. Last year, we saw an attack of the short sellers by the meme stock community, the retail investing community. Is there still a legacy impact of that? Does it affect the way you think about your next shorts?
Well, we did get a lot more tune, and this actually started happening towards the end of 2020. So second half of 2020, we really started thinking a lot more about technicals and flows and passive that must buy a stock and what really is the actual float. Because when you look at the nominal float of stock, when you looked at GameStop, at that time that it squeezed, well, the nominal float was this, but then you take out the Ryan Cohen portion and the Michael Burry portion and the Korean family office portion, and then you've got the passive holders. So there was really only this much float. And when you have this much short exposure to this much real float, that's what you get, that kind of squeeze. So it really did make us pay a lot more attention, not just to the nominal float, but to the actual float and how much passive money was flowing into it. So but that again, that process did start for us in probably July, August of 2020 when we were short this fraud from China called GSX. That guy, Bill Huang, has since been arrested for manipulating that allegedly.
Well, on that note, we're going to leave it there. Thank you very much for joining CNBC today, Carson. Carson Block from Muddy Waters. I'll toss it back to you, Brian.
All right, Jumana Bersecci and Carson Block, thank you. Just a quick note here, a reminder that, again, we have reached out to dLocal. DLO is the ticker on these allegations. They are Carson's allegations with his own proprietary research. If and when the company reaches out to us, we will bring their comments to you. All right, coming up. Remember when the smart money told you back in January that Macy's was going to outperform big tech stocks? Of course you don't remember because it never happened. But that's exactly what's happening. And we'll talk about retail coming up.